Let's get the overall look at how you take a look at 2020. What are you looking for?
So we think that this coming year will be still a good year for equities, not nearly as good as we saw in 2019.
It's hard to be that good, yeah.
Exactly. So we're looking for just limited upside on U.S. equities. We have a target of 3,300 on the S&P 500. We think it'll really be a year where earnings growth drives returns rather than a multiple expansion-driven year like we saw in 2019. And historically, that's what you see when you see years of big multiple expansion driving earnings. Usually, that's followed by years of flattish to down multiples. So we're looking for 8% earnings growth for the S&P 500 next year.
If you get 8% earnings growth, if it delivers what you're expecting right now, will it support the sort of valuations we have right now?
Yeah, I think that's a big factor. So that's one of the rotations that we've been looking for it to continue in the market, is the rotation out of a lot of the crowded and expensive growth and momentum stocks into value. And we see a lot of reasons that continue, but one of the biggest drivers is really just the profits backdrop. So we found that when profits growth is accelerating, investors don't need to pay up for expensive growth stocks. So usually if you see a backdrop where profits growth is picking up, that supports a rotation into value. So we think profits growth should be bottoming out around now, and we will see a pickup in the quarters to come.